you often play the role of a devil's advocate? And when you do, how does the founder react?
Well, the conversations depend upon the stage of the company. And this is something that we have tracked, analyzed over our 9 years experience. So the conversation when you are just launching to the market is obviously different to when you are maybe 50 crores plus.
Yeah.
And then when you cross 100 crores is very, very different. When you cross 500 crores, the conversation changes again. And at every stage, we listen to what the founder is saying, and we do present our own view. And the views may coincide, the views may not coincide. And this, I think, is natural, and it spurs creative energies. This combining of, if you like, intellectual horsepowers is what enables a better outcome. Having said that, at Fireside, we are backing founders. So we are backing their entrepreneurial abilities. And when the founder has a very strong point of view on something, we will always back what the founder has to say. And then time will tell.
Even if your view is contradictory.
Absolutely.
Hello and welcome to Fortune India's In Conversations podcast. I would like to start by asking you a few questions. Which is your favorite shampoo brand, or which is your favorite face wash brand? Or let's talk about food. What's your favorite ice cream or coffee brand? I won't be surprised if your favorites are new age brands such as Mama Earth or Minimalist. Similarly, when it comes to ice creams, I hear a lot of my younger colleagues rave about brands such as Go Zero. Their favorite coffee brand isn't Nescafe, but Sleepy Owl. My guest today is someone who had given the first check to some of today's most sought after cool brands such as Capiva, Bombay Shaving Company, Yoga Bar, and Traya. I have with me Kannan Sitaram, Managing Partner, Fireside Ventures. Welcome to our podcast, Kannan.
My pleasure, Ajita.
Thank you so much for being here and coming all the way from Bangalore. So my first question would be like, as you mentioned a while ago, that Fireside Ventures is almost 9 years old now. And when you first set out to launch your venture capital fund, the concept of direct-to-consumer brands was in its infancy. Today, D2C, the category, is giving stiff competition to to the legacy brands. So it'll be interesting to hear from you, how has the concept of D2C evolved over the past few years? What is so different now?
So let me go back to 2017, when we were raising that fund, which was a small fund at that time. The questions we were being asked is, are you going to get enough deals? And are you going to be able to make money for us? So those are not the questions that we are being asked today. I think we have been able to show that not only do we have enough deals, we actually have a surfeit of deals.
Yeah.
In the last 9 years, we've done something like 70 investments. In our first fund, we already have returned about 4 times the money that we took from our investors. Now the questions that are being asked is, what are the new themes that you are investing behind? What is changing, like you asked, in the whole D2C environment? We have seen that what we invested behind has just gone well beyond our imagination. When we came in, we were seeing the strong emergence of a digital India. We had seen the price of data plunging, and India, even today, has the lowest cost of data in the whole world. That plus the advent of cheaper smartphones just provided democratic access to the internet to millions and millions of people. And on the back of that, we have seen the buildup of e-content and e-commerce. And these two have moved well beyond our imagination. We're now seeing something like 200 odd million people shopping on the internet.
Yeah.
And that has created lots and lots of changes. As you said, when we came in, it was D2C was the new thing. It leveled the playing ground between new entrants to the market
Yeah.
and the legacy brands. You didn't have to be in hundreds of thousands of retail outlets.
Yeah.
You don't need to go on to TV and spend tens of crores of money.
Yes.
You could start with a small budget, launch a brand on your own website, or you go to Amazon and launch a brand, and you could then establish product market fit. If you got the fit, then you scaled up, you raised money. So suddenly the whole game had changed at that time. So that game has moved on, and I think what we see is several sorts of ways in which this game has changed. So first, there are very few pure D2C brands. A lot of the D2C brands, once they achieve a certain scale, once they build a certain franchise, we see demand emerging in the offline world as well. So then to continue to remain D2C is therefore then losing demand. And therefore a lot of D2C brands, people like Mama Earth or Kapiva or Yoga Bar, they're all gone omnichannel. And that has been one big change in the way we have seen things emerging.
But to go omnichannel, most of them have struggled beyond a certain revenue, and they've all got the brands which you mentioned, they've all got acquired by the legacy companies. So is that the trajectory?
Well, Yoga Bar has got acquired by ITC, but that is not true of a Mama Earth. That's not true of a Kapiva. So I think it's an interesting area to think about why some brands go the acquisition route and some don't. In the case of Mama Earth, as you know, the entity is Honasa. And what started off as Mama Earth is now a whole stable of brands. And many of these brands are now very powerful brands in their own right. So the Derma Co, for example, is now a very large brand. They acquired Dr. Sheth, which was a very small brand born in Mumbai, and then they made that a very large brand. They have done other acquisitions as well, like Be Blunt from Godrej is something they took over, and they have made that a very significant brand. So today, Honasa is, yes, Mama Earth is the biggest brand out there, but it's a house of brands.
Yes.
And I think the founders...
And they started off as a D2C.
It started off as D2C. So I think it's the founders' imagination, if you like, to think of a business which can continue to grow. And that's what has enabled Honasa to continue to remain an independent entity, to get listed in the market. Yoga Bar, on the other hand, is a very different kind of trajectory. They were growing with these healthy, better-for-you food options. And they found that to continue to grow, they needed to be big in the offline space. And then they felt that, therefore, to get a strategic partnership is going to be very important for the growth of the brand. And that's the reason why they decided that they should go the strategic route. And then the marriage happened between ITC and Yoga Bar, which has been, I think, mutually beneficial. And the brand has done really, really well over the last 3 years since they signed on with ITC.
Interesting. Staying on the topic of scaling up, your strategy at Fireside has always been that you would just not sign a check or just invest in a company, but you would help them. You would be part of their scaling up journey also. And just as you mentioned, I think Mama Earth is a company which was one of your first investments. And as you said, they are now like, it's a house of brands now. It's not just Mama Earth. Honasa is the company's name, and it's a house of brands. So when you participate in a scaling up journey, it'll be just interesting to hear from you as to what kind of conversations do you have with the founder? Also, even more I'm really curious to know is, do you often play the role of a devil's advocate? And when you do, how does the founder react?
Well, the conversations depend upon the stage of the company. And this is something that we have tracked, analyzed over our 9 years experience. So the conversation when you are just launching to the market is obviously different to when you are maybe 50 crores plus. And then when you cross 100 crores is very, very different. When you cross 500 crores, the conversation changes again. And at every stage, We listen to what the founder is saying, and we do present our own view. And the views may coincide, the views may not coincide. And this, I think, is natural, and it spurs creative energies. This combining of, if you like, intellectual horsepowers is what enables a better outcome. Having said that, at Fireside, we are backing founders. So we are backing their entrepreneurial abilities. And when the founder has a very strong point of view on something, we will always back what the founder has to say. And then time will tell.
Even if your view is contradictory.
Absolutely.
Okay.
Because
any examples that you can share?
Well, for example, where we listened to the founder and the founder was right is Traya.
Okay.
So when we invested, so Traya is into hair loss solutions, and I really believed in the way they were approaching this very large problem, which a lot of brands have tried to solve but haven't been successful. And their solution, they believe in offering a complete solution to consumers rather than just offering a product. And I was telling them, look, there is Amazon, there is Nykaa, there is Flipkart. Why are you not scaling up on all those platforms? And Altaf and Saloni came back to me and said, look, we are not about selling individual products. We want to sell a solution. We are not an FMCG business which is selling individual products. People have to buy the complete set. People have to stay the course for 4-5 months. That's when we're going to be effective. So I said, okay, if that's what you believe in, we'll go with your belief. And their belief has been absolutely vindicated by the market. The business has been successful beyond belief. And it's just truly now a large, profitable business. And I think, therefore, to my earlier point, we back founders, we listen to founders, and then founders are very realistic, sensible people. If something is not working, they're going to come back and say, look, it didn't work. Let's wipe the slate clean. Let's go back and do something else.
So the investor need not be always right.
Need not be always right.
Yeah. So again, now, every other day we get press releases wherein we hear about startups raising Series A, B, C investment. And as a fund which kind of believes in handholding the startup in their growth journey, very often there must have been situations wherein the other investors, the newer investors, their mindset is quite different from that of yours. They may be quite contradictory. So how do you manage those kind of situations? Does hand-holding at that point of time become a challenge for you?
In most of the multi-investor situations that we are in, the other investors on the cap table are financial investors. What unites all of us is that we need to exit over a certain period of time.
Yeah.
We need to demonstrate that our investment made money for our investors.
Yeah.
And so there will be different points of view, different points of view on strategy, different points of view on how to raise money. But what we align over is, finally, we want to create value. And how do we think about creating value? So if you place that at the center of the table and say, look, there are different points of view. How do we think about value creation? I think we are able to then iron out differences. And I've seen this work every time. It works with founders. It works with investors. If you're able to have an aligning conversation around something like creating value, I find differences can be resolved. I think the important thing is to not attack the detail, but to create alignment around what is a common purpose around the table.
Interesting. Today, we see a lot of legacy companies, acquiring D2C brands. And for them, it is just kind of easier to acquire a D2C brand rather than, building it organically. Is that a good strategy? Because does a legacy company, because I know Wellbeing Nutrition was acquired by HUL, and then kind of they divested. And, I don't think the marriage really worked. So is it really a good idea for a legacy company to, acquire another D2C brand? Because the way they function, the talent they have is quite different from what a new age D2C company has. So, what is your take on that?
So just to set the record right
Yeah,
on
yeah.
HUL and Wellbeing,
Yeah,
they took a minority stake,
yeah,
and it was very clear to everybody that they were a financial investor.
okay,
It wasn't unlike the ITC deal with
yoga bar,
which was
yeah,
a very clear path to acquisition over 3 years.
okay,
Here, that was not embedded in the
yeah,
discussions or the
yeah,
agreement. But to your point, the reality of the big legacy companies in
yeah,
India
yeah,
is that they are very highly profitable.
yeah,
Their growth rates are low.
yeah,
And when you combine the two,
yeah,
their ability to experiment, to incubate something over long years
yeah,
doesn't exist,
okay,
right? And that's the struggle that they have. And then how do they get into new spaces? How do they get to where disruption is happening?
yeah,
How do they therefore continue to grow, because
yeah,
some of the earlier brands will plateau and decline?
yeah,
And that's where the acquisition piece comes in. You look at the legacy companies' balance sheets, they're sitting on tons of cash,
yes,
right? And every year they're generating more tons of cash.
yes,
So they're using that cash to essentially acquire brands which fit their strategic framework,
yeah.
and where there is incremental growth over what they are getting.
But what about culture?
Culture is definitely something which needs to be addressed. Uh, and the way they do that is, first, many of them leave the company that they're acquiring outside the main company for a certain amount of time. I think the guys who have done it most successfully have been Marico. They have actually created this as a playbook,
Yeah,
that they invest in a company, take a controlling interest, uh, have a path to acquisition,
yeah,
don't get into the way the company is being run, incentivize the promoters of the company to continue to scale and create value. And then at the end of a certain period of time, they take the brand inside. So at that point in time, it becomes a Marico brand. It's part of Marico. Marico manages it. So therefore, you avoid the culture conflict that could be there.
interesting.
So I think therefore people are coming to think about how to make sure that they don't put in large company rule books onto small company and stifle innovation and growth, and how to have a successful way of acquiring smaller companies.
Interesting. How is a founder's perspective evolving? In today's times, like, are they? Earlier, we used to hear about a founder building a business for the long term, and there were this set of founders who were building a business to sell. Uh, you know, which of the two are more prevalent now? What really is playing in the minds of founders? What kind of conversations are you having?
So we invest behind founders who are building businesses that they want to continue to build.
Yeah,
Um, we believe those will be the most successful businesses. Those will be the businesses where real value is created. If somebody is building to sell, the chances are that they may not build it the right way. So I think we are very clear in our investment strategy that we are investing behind founders who got the ambition to continue to scale and to build very large businesses. Now, having said that, those ambitions may be successful, may not be successful. At that point in time, I think then the conversation has to be about, you wanted to get to some place, it looks like it may not happen. Is it time for you to think about selling your business to a strategic acquirer? So I think it's a conversation which happens along the way, and not something that at least we want to invest behind.
how do you help them deal with the dilemma of profitability, scale, margins? what kind of conversations do you have? How do you help them manage all of that? Because clearly, a business needs, has to acquire a certain bit of scale to be successful. So, how do you, as an investor, what kind of advice do you give them? What kind of handholding?
Frankly, it's not such a dilemma. Uh, where are you spending money? Where are you losing money at the early stages? You're losing money because you're acquiring customers. You're losing money because you are building an organization. You're losing money because you are innovating, launching lots of products, many of which may not succeed, right?
Yeah.
So that is a good reason to lose money, right?
Yeah.
And we think that they should lose money at that stage.
Yeah.
But there comes a stage where you find that many of the products are really developing a fandom with consumers, right? And then there are repeats, right? So when there are repeats, then you don't have to spend on acquiring customers, but you do need to spend on retaining customers. You do need to make sure that your product quality is very good, and that you are then communicating with customers in a way that they come back to what you're selling. And a repeat customer is always way more profitable. The same thing with product innovation. In the initial stages, as I said, you continue to experiment, you continue to launch new things. But once you find that some things are clicking, then I think founders need to think about that deeply, need to think about, okay, I've launched a shampoo which is doing very well. So maybe I have a right to win in hair care. So can I go more deeply into hair care? So there is a need to think category-specific innovation, rather than innovation in hair, in skin, and body, in face, in in all the different BPC areas. And the same thing with foods, same thing with everything. So you need to start focusing innovation into areas where the consumer thinks that you are offering something truly remarkable. So that again, you spend less on innovation, you spend in more focused areas, where you already have developed some traction. And then as you grow bigger, yes, you continue to add to the team, but you're also building scale on the revenue side, and therefore, your organization does not need to scale at the same level as your revenues are. And so the economics of the organization start to look better if you're getting these three things sorted out. So I think well-run startups should start improving the economics. I'm not saying straight away you get to being EBITDA positive, but is your gross margin right at the beginning? Because unless that's a function of the price at which the consumer is going to buy. If the consumer is not willing to give you that price, the gross margin will not be there. Therefore, you're not doing something right. So the first thing right from the beginning is your gross margin. Then is really your CM2, which is what you're spending to acquire customers and so on. Then comes your CM3, which is about retaining consumers, also acquiring consumers more efficiently through brand marketing. And then comes EBITDA, when your organization building efforts are, more or less done, and therefore you're scaling your overheads less than you're scaling your revenues. So I think you gradually need to work your way towards profitability.
Interesting. Again, I see you as a fund investing a lot more in businesses which are rooted in smaller towns. I mean, they could be a business which is headquartered there, or it could be a business like Sweet Karam Coffee, which is, which is taking regional food to across the country. So, what really is the rationale? Do you see? And you also have a business called Rosanna. You've also invested, which is into rural supply chain. So, what really is the rationale?
Well, I mean, to expand on what you said, so we now have investments in Chennai, two of them. We have investment in Jaipur. We have investment in Ahmedabad, something in Kolkata. We're now investing something in Lucknow. So I know I'm missing out one or two other towns outside the
So
big
from
three.
metros, you've moved
Yeah.
into tier 1, tier 2.
I mean, go back to Fund 1, it was really Mumbai, Bangalore,
Yeah.
NCR.
Yeah.
So I think there is a wider dispersion. I think the first thing is we are just seeing great founders everywhere.
Yeah.
So it's not necessarily that, as you said, the business is targeting that geography.
Yeah.
We're just seeing great founders coming in many places. And our job is to find those founders, to have conviction behind those businesses and to invest in them. But apart from that, we do see that what was going back to 2017, really businesses which were targeting what I may call India 1,
Yeah.
the more affluent, the more upwardly mobile consumer. That's not where the market is going to be. There is an increasing level of aspiration in India. So what may be called India 2 also wants to buy things which improve their sense of well-being.
Yeah.
Whether it's that better skin cream or the better shampoo, better clothes, better homes, better food. Their aspiration levels are increasing, their income levels are increasing, and all of that means that demand is increasing everywhere. You talked about Rosanna.
Yeah.
I mean, that's a brilliant example of how Ankur and Advaita created this wonderful way of getting into really rural India,
Yeah.
into villages that the big consumer companies are not getting to actually. And there they are saying that what is really the situation is not that people are struggling to buy things, but they're struggling to get things.
Yeah.
There is really a supply issue because to buy lots of things, the local little shops can't supply them.
Yeah.
They have to go to the nearest town to buy stuff.
Yeah.
And they're trying to solve for that. And as they solve for it, they find that the demand for fashion, one of the things that people seem to be asking for in these small towns is saying, can I have a cake for my daughter's birthday? Because they're seeing that on television. They're seeing, how people are celebrating birthdays and they don't get cakes.
Yes.
So that aspiration is there even in, small villages. And therefore, I think we as investors need to find startups which are catering to aspiration wherever that may rise.
In fact, I can really relate to the cake instance which you cited. Me and my colleague were reporting at the Sonpur Ka Mela in Bihar, and it's a rural fair. And there we saw a pastry thela, which was very interesting and which kind of, really proved your point that people are aspirational even in villages. But again, it'll be interesting to hear from you how different are founders from how different is the founder mentality and in tier 2, tier 3 India from that of the metro markets? Is it any different?
Well, I think what I have seen, and I think the gap is narrowing,
Yeah.
but in the three metros where there have been lots of investments, we found that the founders are very savvy. They're all networked. They come fully prepared. They know that if they come for a fireside pitch, this is what Kaval is going to say. This is what Kannan is going to ask. So there is a level of
They've done their research.
savvy out there.
Yeah.
Whereas I go to a town, and it's not a small town, Chennai, but where I find that people are not so conversant with what venture capitalists are all about, how they do investing, what changes when a venture capitalist come on board. So there is a bit of education at times that is involved out there. I think they are as smart about how to run a business as founders anywhere else. But it's this whole area of how venture capital works that could be a little different.
Even now.
But I think the knowledge gap is closing fairly fast.
Okay. So I would like to end this conversation by asking a very general question as to how do you see India's consumption story evolved in the next few years? The reason I'm asking you is I was talking to a FMCG distributor who's out of Jaipur, and he was telling me as to how more and more people are kind of moving towards consuming D2C brands. And he talked about shampoos. And he said that there were more takers for brand called Nat Habit, which I think you have invested, rather than a Dove or a Clinic Plus. So, how do you see this whole consumption story evolve? Where do you see legacy companies really getting getting challenged even more by the D2C brands?
So, if you were to look at disruption, there are three things disrupting consumption today. And on that, there are lots of trends which are emerging. The three fundamental things are, one has been rising incomes. And we just see India growing at 7%, and on a per capita basis, that's about 5% increase at a real level per year. And then that cumulates, you take 10 years, at 60, 70%. So that's sizable. And along with that is the whole digitization of India, which just makes access to brands, access to content far more than it ever was, going back, and it will continue to increase. The third thing is the advent of a new generation, the Gen Z. We saw how consumption changed when millennials started consuming 10 years back, and that again is happening with Gen Z. Now, the issue for legacy brands is, how do you change to align with all these three disruptions? And it's very difficult, because a Gen Z consumer is going to ask for very different things from a consumer who is, let's say, 40, 50 years old, right? In fact, many Gen Z consumers say, we will not use the brand that my mother uses. So they're anti-legacy brand in many ways. So there are headwinds. Yeah. And I think, therefore, that's something very difficult for the big companies to solve. The other piece is that when we didn't have digital India, the big brands wanted to homogenize consumers. I go back to my days at Hindustan Lever and Dabur. We described consumers as women aged 15 to 45, living in urban India, earning about so much, right? And that was such a crude depiction of a consumer segment. And we did that because when you came to media information, that was a kind of slices in which targeting was possible. But today, when you talk to a Meta or a Google, the kind of slices of consumer segmentation you can do are so fine. And then you look at what's changing with that consumer. You look at what they're looking for and how that's not getting addressed by the brands in the market. Opportunity. And so the opportunity is being created for more and more brands by looking at all the underserved consumers, who are now able to afford what they want because their incomes are increasing and access has improved.
Thank you, Kannan, for taking us through the world of building and sustaining direct-to-consumer brands. Do you feel inundated with new age brands each time you log into a quick commerce website? Or do you think there are too many brands? Let me tell you that India is hugely underpenetrated in terms of brands. There is opportunity galore for more brands to come up. I really hope you enjoyed this chat as much as I did putting it together. See you soon.